In this video, we're going to be going over GrubHub and the financials of the company. Much of what we're talking about relates to a previous video where we go over an overview of the online food delivery market and the mobile food delivery market. The link to that is in the description as well as just up right here. GrubHub has found itself amidst a very explosive trend that is online and food delivery, and because of this, it has grown as a dominant player in this market. With market share of about 20%, their sales have exploded over the years. Their business model is to take a portion of sales from restaurants for providing an effective, convenient, and infallible service of handling the delivery and order process. They have built up a vast network of relationships with restaurants and consumers that has spread far and wide across America. Some interesting stats regarding the company are 416,000 daily average GRUBS. That is 416,000 different orders conducted in any given day. 1,600 cities across the United States, 80,000 restaurants, and 16.3 million active diners. That is 16.3 million people that are members on their app, or 5% of America's population. And given that they get a portion of sales, a crucial metric in analyzing the company is what Bloomberg refers to as GMV, gross merchant volume, a term interchangeable to GrubHub's gross food sales. This is the term they use in their corporate filings. This term tells us the raw dollars diners have spent on the platform. And GrubHub's top line is almost completely derived from this figure. In the last few years, gross merchant volume for the online food delivery market has gone from 9.8 billion to 19.7 from 2014 to 2017. At the same time, GrubHub's gross food sales has gone from 1.7 to 3.7 in the same time period. Therefore, they have represented a market share of the GMV online food market of between 18 and 19%. And as I said, given that their top line is derived as a portion of gross food sales, their top line in the same time period has been as follows: 253 million to 683, which means their cut of gross food sales has risen from 14 to 18%. This is what we like to refer as a top line analysis. By first getting the estimations of the market, GrubHub's portion of that market, and then GrubHub's sales, we can accurately derive how much sales GrubHub will make in the future. And our estimates show that in 2019 the market will rise to $30.6 billion, going to $55.3 billion by 2022. If we can imply that GrubHub maintains about an 18% market share, their gross food sales over the same time frame going forward will range from 5.5 billion all the way up to 9.9 billion. And given that their revenue is a portion of their gross food sales, with their most recent figures showing it to be 18%, GrubHub's revenue will be extracted as follows. Now that we have the sales estimates of the company, we would like to analyze the price to sales ratio in order to imply a value of the stock going forward. The 5-year average price to sales ratio of GrubHub is 9.6. Please keep in mind this is well above the market average and is considered high by relative metrics. However, for a fast and explosive growth stock, this often ends up being the case. GrubHub's diluted shares outstanding stand at 93.6 million, and with the sales estimates and the shares that we now have, we can get a sales per share over the next few years as follows. If we apply the 9.6 price to sales ratio, the value of the stock in 2019 by our estimates will be $102 and will rise over the years to a long-term estimate of about $184. A number of risks that you should take note of is that this market is becoming increasingly more competitive. With EBITDA adjusted margins of about 30%, it makes sense that many other companies such as DoorDash, Skip the Dishes, and Uber Eats are revving up to try and take market share. Should they succeed, our estimates of them having 18% market share may have to be readjusted. However, we don't think that is likely to be the case because GrubHub has a first mover's advantage, and a first mover's advantage seems to be important because data from McKinsey shows that 80% of users are likely to stay with the app they first tried. This implies that there's somewhat of a switching cost, albeit psychologically. Their PE is around 50, which is often typical for fast and growing companies. And the high PE is usually a commensurate to high growth, and GrubHub has been growing as you saw But more specifically, their top-line sales have grown at about 37% in the last 3 years. And they don't have the debt issue that many other tech stocks do. Netflix, for example, had a PE of about 100, going almost near 300. The worrying debt issue is their biggest problem right now, a debt issue that doesn't really occur with GrubHub. GrubHub's long-term debt is $290 million, and their short-term debt is $6 million. However, GrubHub has $294 million just in cash and equivalents on their balance sheet. So in other words, just the cash and equivalents they have on their balance sheet can serve their debt, both long-term and short-term. We like to compare Netflix and GrubHub because they attract the same kind of consumer and serve a more long-term trend, which is the ultra-convenient, stay-at-home form of entertainment. GrubHub, in our idea, complements the experience, which is the ultimate night in. You can pair your favorite food with your favorite TV show or movie. GrubHub has momentum. This market is not slowing down. And though it may be on the riskier ends of things, I believe shareholders will be rewarded handsomely and incommensurate to these risks. Let us know what you think, comment down below, and give us a subscribe. Thanks for listening, guys.